Now let's go into Unit 8, which covers non-recognition property transactions. Now we cover non-recognition property transactions both in Book 1 as well as Book 2 because non-recognition property transactions can apply to businesses like a corporation or a partnership can have a non-recognition property transaction, and an individual taxpayer can too. But there's only one non-recognition property transaction that only applies to individuals, which means individual humans, and that's the sale of a main home. Because a corporation or a partnership can't have a main home like an individual human person can, right? A main home is a home that you live in the majority of the time. It's your primary residence, and a corporation or a partnership or they can't have a primary residence, right? It's an entity. So we're going to talk about the sale of a main home in this webinar. And it's kind of a complicated topic. There's a lot of ins and outs with this particular transaction, right? The Section 121 exclusion is what it's called. So we're just going to discuss that in this webinar. And it's going to be a pretty long webinar just discussing that particular topic. The other two types of non-recognition property transactions, which are involuntary conversions and like-kind exchanges, 1031 exchanges, I cover in a crossover webinar. So check your crossover videos folder and watch that video before you take part 1 or part 2, because a individual human can have an involuntary conversion. That's when property is destroyed, for example, by a natural disaster, and that can happen to a business too. A like-kind exchange can also be done by an individual as well as a business. So an individual taxpayer can own a rental property and do a like-kind exchange on that rental. And then a business, like a corporation, can also do a like-kind exchange on something like an office building too. Like-kind exchanges and involuntary conversions can happen to both businesses and individuals. So there's just one big long webinar about that in the crossover videos folder. And then we're just going to cover the sale of a main home in this webinar because only individuals can sell their main home. That particular code section only applies to individual humans, not to businesses. So this is called the Section 121 exclusion. It's IRC Section 121, which is why it's called this. Just so you know, this law has been around for a really long time, but it's been modified through the years. So the precursor law to Section 121 was Section 112, which was enacted in 1951. And I want you to know about it because sometimes you will still have older taxpayers that will come in and they will have a misunderstanding of this law because the old law was in place until like the late 90s. And back then, if you sold your home and you had a profit on the sale, then if you reinvested all of the profit into another home that cost either the same amount or cost more, then you wouldn't have to recognize the gain. That's the old law. And you'd think that maybe the 90s was a while ago, that maybe people wouldn't still think that this was the law, but I still have taxpayers talk about this. And just as early as last year on one of the bookkeeping groups, one of the bookkeepers in the group, she's obviously not a tax person, but she's a bookkeeper. She mentioned this. She said, I heard that you don't have to recognize the gain as long as you reinvest the proceeds. No, that's the old law. That hasn't been the law since the 90s. So the rule isn't whether or not you reinvest the proceeds anymore. That's not the rule. The Section 121 is different than that. But I just want you to know that sometimes you will have older taxpayers that will come in and still talk about the old law, saying, oh, I sold my house, but I reinvested the proceeds in a new house, so I don't have to pay tax on the gain, right? And that's not what the rule is. It has nothing to do with whether or not you reinvest the proceeds. All right, I just want you to understand that. Sometimes people will still come in and talk about that old law, but that's not how it is anymore. All right. So the current law, which is Section 121, allows a taxpayer to exclude the gain from the sale of a main home, and it's up to $250,000 of gain basically per person. All right, per person. There's an exclusion of up to $500,000 by joint filers. And there are special rules for married couples. But if you have, like, for example, an unmarried couple that own a house together, then they can exclude up to $250,000 of gain each, right? They would sell the home and then they can exclude up to $250,000 each. But when it's a married couple, it's $500,000. It's still $250,000 each, right? A married couple is two people, but there's special rules for married couples that are a little bit more favorable than the rules that are for either unmarried couples or even just, maybe you have two sisters or two brothers that own a home together and live in it. You can have that as a scenario too. So generally, if the taxpayer can exclude all the gain, it's not even necessary to report the sale. Okay, that's the IRS's position, that if the taxpayer can exclude all of the gain, it's not even necessary to report the sale. That is technically true. That's technically true. But I just want to tell you right now that one of the most common types of underreporter notices that I have seen in my career is from taxpayers who had the sale of a main home. They were allowed to exclude all the gain, but then, the escrow company issued a 1099-S, that's the form for the sale of real property. And many times the IRS will send an underreporter notice anyway. So the IRS will think that it's a taxable sale. And even though all of the gain can be excluded and it didn't have to be reported, what will end up happening is the IRS will send a notice to the taxpayer and you'll have to respond anyway. So it's just easier to just report the sale. And if all the gain is excluded, then exclude all the gain. There'll be an override in your software. There'll be a place to put it, but you will be able to avoid a notice later. Just experienced tax professionals who have been in this business a long time, especially if you practice in a state with very high real estate values like California, New York, anywhere where the real estate can be sold for over 500,000, 700,000, $1 million for a house. Many times you will get that underreporter notice anyway, even if it's a situation where all the gain can be excluded. So just save yourself the headache of having to respond to that notice. And also, IRS notices freak taxpayers out. They get really nervous. Even if it's a situation like this where you can easily write a letter and solve the problem, it still makes people really uncomfortable, your clients. So my suggestion is to always report the sale, even if all of the gain can be excluded. But technically, you don't have to report the sale if all the gain can be excluded. But once you respond to like your fourth or fifth underreporter notice with this thing, you'll be reporting all home sales from there on out. Just trust me. Once you've done it enough times and you just get sick of it, sick of responding to those notices, then you'll start reporting all the sales, right? Okay. Now, gain from the sale of a residence that is not the taxpayer's main home must be reported as taxable income, and then it doesn't qualify, all right, for the Section 121 exclusion. This is just for the sale of a main home. Section 121 only applies to a main home, not to rental properties, vacation homes, or second homes. And the IRS classifies the taxpayer's main home. The definition is the residence where the taxpayer lives most of the time. So the residence where you spend most of your time. It doesn't have to be a traditional house. It can be a houseboat, a mobile home, a cooperative apartment, or a condominium. In order to qualify as a home, it must have sleeping, kitchen, and bathroom facilities. Now, if the home was used for business purposes or as a rental property, the gain is reported on Form 4797, Sale of Business Property. So I want you to understand that it's possible for a person to still qualify for the Section 121 exclusion, even if the home is not the taxpayer's main home right now. It's not uncommon for people to move out of their main home and then put it up as a rental property, thinking, oh, I'm going to keep it as a rental property, and then rent it for a little while and then say, I don't want to do this anymore. They don't want to be landlords, or it's too much of a hassle or whatever. So there's a look back period where the taxpayer can still qualify. The taxpayer still has to meet the tests, and I'm going to go over what those are in a minute. But it is possible for a taxpayer to sell a home that was their main home, still get the Section 121 exclusion, but if the taxpayer did convert it to a rental property for a short amount of time, like a year or 6 months or something, and took depreciation on that rental, then the gain has to be reported on the Form 4797 in order to recapture the depreciation deductions. All right, you can't exclude that gain. Okay, the Section 121 only applies to the non-business portion of a home. Taxpayer can still qualify for the Section 121 exclusion even if the home is converted to a rental property, or if it was a rental property in the past, and then, for example, the taxpayer moves in and start using it as their main home and lives in it for a couple of years, and then they qualify. But the amount of depreciation that the taxpayer took, that amount can't be excluded. All right, they have to recapture that back. Okay, eligibility requirements. So in order to be eligible for the Section 121 exclusion, the taxpayer must have sold his or her main home. Has to be a main home. Can't be a vacation home or a second home or anything like that. The taxpayer has to meet the ownership and use tests. Ownership and use, two separate tests, and I'm going to go over those. And then the taxpayer cannot have excluded gain in the 2 years prior to the current sale of the home. So it's possible to qualify for the Section 121 exclusion multiple times. You can buy a home, sell it, exclude the gain. Buy another home, sell it, exclude the gain. But the taxpayer has to wait in between, these acquisitions of homes and then selling them. You can't have excluded the gain in the 2 years prior to the current sale in order to qualify for the Section 121 exclusion. So you got to wait a couple years in between these home sales if you want to qualify for the Section 121 exclusion. The IRS figures the ownership and use tests separately, and the time periods do not have to be continuous. So during the 5-year period ending on the date of the sale, the taxpayer must have owned the home for at least 2 years. This is the ownership test. And then lived in the home as his or her main home for at least 2 years. This is the use test. And these do not have to be continuous. And there's a 5-year look back period. I want you to understand this. You look back 5 years to see if the taxpayer actually owned the home for at least 2 years and actually lived in the home for at least 2 years. So the taxpayer will meet both of these tests if he or she owned and lived in the property as a main home either 24 full months or 730 days. That's 365 times 2. Just remember this for the test, because it's possible that the IRS will ask you to calculate a reduced exclusion. And it's based on 24 months or 730 days. And I'm going to show you how the fractions work and how to calculate this math. But just as an aside, I want you to realize that if you do get a question like this on the exam, and it's a question about the Section 121 exclusion where they're going to ask you to calculate a reduced exclusion, I'm going to show you how to do it. And the math is not difficult. But if you do get a question like this, I suggest that you guess and then come back to it. You're going to have to calculate the math, right? And it's based on a fraction. And like I said, I'm going to show you how to do it. But if you do get a question like this where they ask you to calculate the exclusion based on the number of days that the taxpayer owned and lived in the property, I want you to take a guess, mark it, and then come back to it if you have time at the end. All right, that's just good testing strategy. Now, as I said, the 2 years of ownership and use don't have to be continuous, and the ownership and use test can be met during different 2-year periods. I know it's hard to wrap your head around that, but I'm going to give you examples so you understand. The IRS has stated that if you have a short temporary absence, even if the property is rented during those absences, that's still counted as periods of use. It's counted as if I am living in the property. The IRS defines in the publications, in the IRS publications, what a short temporary absence is. And they say that this includes vacations and seasonal absences. So you can spend a month or 2 months away from the home. Like I go on vacation for 2 months. The IRS still considers that a period of use, like I'm living in the home. So it would be counted as a period of use. But if you take a longer break, then that is not included as period of use. And the IRS example in the publications is a sabbatical. So if you go on a year-long sabbatical, if you're away from the house for a year, then that's not considered a period of use. So if you go on like a mission trip or a 1-year sabbatical, you're away from the house for 12 months and it's vacant, or even if it's rented, then that's not considered a period of use. It's considered a period of ownership, right? Because you still own that house. So you would count it as part of the ownership period, but you wouldn't count it as a use period if you were away from the house for a year. Now, there's different rules for married homeowners, and these are beneficial rules for a married couple. So the ownership and use tests are applied differently to married homeowners. Married homeowners can exclude gain of up to $500,000 if they meet all of the following conditions. If they file a joint return and either spouse meets the ownership test, this means that only one of them has to own the house. So if I am married, my husband and I, we live in a house together, but only he owns it. He's the only one on the deed and on the mortgage, but I am married to him and I live in the house with him. But there's only one owner. We are allowed to exclude up to $500,000 of gain as long as we file jointly, as long as we meet the use test. But only one of us has to own the home. Now, if they don't satisfy these requirements, the couple cannot claim the maximum $500,000 exclusion for married couples. However, one spouse may figure his or her exclusion separately if only one spouse qualifies. And I think if they're going to throw a question like this at you on the test, then they're going to give you a situation like this, a scenario like this, where the spouses would meet all of these tests, but then they decide to file separate returns. So if it's a situation like this and it's a married couple and only one of them owns the home, but otherwise they meet all of the tests, they have to file jointly in order to take that $500,000 exclusion. So if my husband owns the home, but I live in the home with him and we're married, in order to claim a $500,000 exclusion, so $250,000 for each of us, we would have to file jointly. If we decide to file separately, then he would get a $250,000 exclusion, but I wouldn't get an exclusion because we're filing separate returns and I don't own the house, right? Now, if we both owned the home, like I'm listed on the deed and he's listed on the deed, then it wouldn't matter if we filed separately or jointly because either one of us would be able to qualify for $250,000 exclusion. But if only one of us owns the house, then we have to file jointly in order to get the full $500,000, which is $250,000 for each of us. Okay? Now, unrelated individuals, an unmarried couple or other taxpayers who own a home and live together may take the $250,000 exclusion individually on their separate returns if they meet the use and ownership tests. So a lot of times you'll have people who are an unmarried couple that own a house together, or even people who are not a couple who are related to each other, like sisters or brothers, or even just friends that own a house together. And they're not a couple, but they came in together and they decided to buy a house together and live in it together. If that happens, then what ends up happening is the ownership and use tests are applied to each one of those people individually, and they're allowed to claim the $250,000 exclusion per person on their individual returns. Here's an example. Selma and Carolyn are sisters. They both are widowed and decided to purchase a home and live in it together. So this is actually pretty common for siblings who are older and maybe they're widowed, right, or divorced, and they decide to just purchase a home and live in it together. If they later decide to sell the home, the ownership and use tests would apply to them individually. So individually, they would both have to own the home and live in it for at least 2 years. Each would be able to claim an exclusion of up to $250,000 for her portion of the sale on her individual return. And they would just divvy up the proceeds and then claim the exclusion on their individual tax returns. Now, sometimes if you have a 1099-S from the sale of a property like this, sometimes the 1099-S will be incorrect or it will be allocated to just one person. And that's fine. What ends up happening is you just have to do the math, right? You bust out the spreadsheet and your calculator and you have to do the math on your work papers and make it work on the tax return. You're not doing anything wrong if you actually report the reality of the transaction, right? You report the reality of what actually happened. If there's two people and they own the house together and they both qualify for the exclusion, but they're an unmarried couple, or if it's a situation like this where it's two sisters, and you just report the sale as it is. So each one of them legally is allowed to exclude up to $250,000 of the gain. All right, and that's what you would do. Deceased spouses. Let's talk about the special rules for deceased spouses. So when one spouse dies, the survivor is considered to have owned and lived in the home during any period of time that the deceased spouse owned and lived in it as a main home. This is provided that the survivor did not remarry before the date of the sale. That's important. So if the survivor remarries before they sell the home, then all bets are off. But if you have a situation where you have a married couple and one of them dies, then the survivor is still allowed a $500,000 exclusion from the sale. And they're allowed a $500 exclusion from the sale, and they're allowed to tack on the holding period of the decedent, so the deceased spouse. And they're allowed to exclude this gain within 2 years from the date of death of the deceased spouse. Now, it used to be many years ago, if one spouse died, then in order to exclude $500,000 of gain, the survivor had to sell the house in the same year that the other spouse died, basically in the year of death. Because the year of death is the last year that you can file a joint return with a decedent, right? So if, my husband and I are married and he dies, then the year of death is the last year that we can file a joint tax return together. But the rule for the Section 121 exclusion when there's a deceased spouse is a little bit more generous. So the survivor is actually still allowed to exclude up to $500,000 of gain if he or she sells the home within 2 years from the date of death. So the survivor has 2 years to sell the home and still exclude $500,000 of gain if one spouse dies. Now, the rules are not the same if it's a divorce or something like that. This special rule only applies when there's a death. Okay? Special rule for deceased spouses. Now, there's also a military personnel exception with regards to the look-back rule. Now, this only applies to members of the military because members of the armed forces are often required to move and might have difficulty meeting the test for ownership and use within that 5-year period. So for everybody else, the look-back period for ownership and use is 5 years. You look back 5 years to see if you can meet those tests. But with members of the armed forces, you can look back 10 years. So the 5-year period can be suspended for up to 10 years. For U.S. military and foreign service personnel and Peace Corps workers and intelligence officers that are on official extended duty. I guess intelligence officers would be like CIA, FBI, or something like that. But this is the military personnel exception, but it applies to these other people as well. So Peace Corps workers, foreign service personnel, blah, blah, blah. Now, this provides the taxpayer a better opportunity to meet the 2-year test instead of the normal 5-year period required of other taxpayers. And I'm going to give you an example of this too, so you see how the math works. Now, there's a disability exception to the use test. So it's still a 5-year look-back period, but if a taxpayer becomes disabled and they actually have to move out of the house because of their disability, for example, if I purchase a home and I'm living in it, and then I have a physical or mental disability that forces me to go live in a licensed facility or a nursing home or something like that, then as long as I lived in the home for at least a year, then I'm considered to have met the use test as long as I meet the 2-year ownership test. I still have to meet the 2-year ownership test if I want to take that full $250,000 exclusion. That's what we're talking about here. We're not talking about a reduced exclusion. So you can have a reduced exclusion too if you become disabled, where you're allowed to still exclude part of the gain, but not that full 250,000. But in this case, if the person becomes disabled and they have to move out of the house, they're still allowed to exclude the full amount of the gain, the 250,000, as long as they lived in the home for at least a year, but owned it at least 2. All right. They still have to meet the 2-year ownership test in order to take the full $250,000 exclusion. And I'm going to give you an example of this because I know it's kind of hard to wrap your head around it. But if the reason why the taxpayer moved out, so he's not using the home anymore, is because of a disability or some physical ailment or a mental disability, then as long as they lived in the home for at least a year and owned it for at least 2, then they're still allowed to take the full $250,000 exclusion if the reason why they moved out was because of a disability. Now, reduced exclusions. Now, this is where the taxpayer is still allowed to exclude some of the gain, but not the full $250,000 per person. And right, so it's $500,000 for married couples. But this is where you would be able to take an exclusion for some of the gain, but the amount that you can take is reduced. The taxpayer who owned and used the home less than 2 years and therefore does not meet the ownership and use tests, or has used the home sale exclusion within the prior 2-year period, may still be able to claim a reduced exclusion under certain conditions. This may apply if the home sale has occurred primarily because of unforeseen circumstances during the taxpayer's period of use and ownership. Now, the IRS gives like wide latitude with regards to what qualifies as an unforeseen circumstance. I'm going to go over the unforeseen circumstances that are actually listed in the IRS publications because that's what you need to know for the test. But just realize that there are many other types of unforeseen circumstances where the IRS has accepted the taxpayer's scenario as being an unforeseen circumstance that qualifies for reduced exclusion. I mean, there's literally dozens of PLRs out there that you can look up where taxpayers have asked the IRS, does my particular situation qualify as an unforeseen circumstance? Am I allowed to exclude this amount of gain? And the IRS has said yes. But we're going to talk about what's in the pubs, all right, because that's what you need to know for the test. So, unforeseen circumstance include the following: death, divorce, or legal separation. Certain health-related reasons related to the care of the taxpayer, a spouse, a child, or certain other related persons. The related person does not have to be a dependent for the reduced exclusion to apply. In order for this particular unforeseen circumstance to apply, it doesn't have to be a dependent listed on the tax return. It can be a situation like a parent or a sibling that's not a dependent, but you're forced to sell your home and then go take care of them because of a health-related reason. So for example, let's say I bought a house and I've lived in it for 1.5 years. It's my main home. And I have equity in the home, so if I were to sell it now, I'd have a $100,000 gain, let's say. But I'm not going to be eligible for the full exclusion because I haven't lived in it and owned it for 2 years. But 1.5 years pass, and then all of a sudden my father breaks a hip and I have to go take care of him, and he's going to be convalescing for 6 months. So I decide I'm just going to sell the house and go take care of him in California, right? In that case, that would be an unforeseen circumstance. And if I sold my home, then that move, right, to go take care of a family member would qualify for the reduced exclusion. I would be able to exclude a portion of the gain, and it would qualify for reduced exclusion because it's a certain health-related reason. Right? It's my father, right? In my example that I just gave you, it's my father. Doesn't have to be someone who's listed as a dependent on my tax return. Okay? It can be a close family member, and that will still qualify. Now, unemployment or a job change, this is the job change exclusion, and it applies if the new job is at least 50 miles farther from the old home than was the former place of employment. This is basically the same rule that applied to deductible moving expenses back when moving expenses were deductible for everybody. It's that 50-mile rule. But this will also qualify, the sale will also qualify for reduced exclusion if it's just unemployment. So if I lose my job and I can't afford the mortgage anymore, so I'm forced to sell, that also qualifies. I don't necessarily have to go to work at a new job, but if I lose my job, then that also qualifies. Or if I have a job change, like I get transferred to another city, if it's at least 50 miles away from my old workplace, then that would qualify for reduced exclusion as well, the sale. If you have multiple births resulting from the same pregnancy, so twins, triplets, something like that, you would also be able to qualify for reduced exclusion. Any damage to the residence resulting from a disaster, an act of war, or terrorism, and that's involuntary conversion. So that would be an involuntary conversion of the property. So if you have a situation where you're forced to sell because your home is flattened by a hurricane, or you're forced to basically leave the area, right? Because your house is flattened by a hurricane, then that's an involuntary conversion. If by some miracle you still have a gain on the sale of your destroyed house, then that would qualify for reduced exclusion as well. Now, the circumstances may involve the taxpayer, a spouse, a co-owner, or a member of the taxpayer's household. The IRS also has discretion to deem other circumstances as unforeseen. So if you have a situation where it's a co-owner of the property, for example, if I own a house, but I own a house with my brother, or let's say I'm unmarried and I own a house with my boyfriend, then if he has a health problem, right, or if he dies, then he's a co-owner of the house. Nothing particular happened to me, but if something like that happens to the co-owner, then obviously it's going to affect me, right? Might not be able to pay the whole mortgage, right, by myself. So in that case, that would also qualify for reduced exclusion if it's a situation like that, where maybe I have a co-owner of the property, even someone like a boyfriend, where they're not technically related to me, right? They're an unrelated party, and they own the house with me, but then they die, right? And then now I'm the sole owner of the house and I can't afford the mortgage anymore, so I have to sell it. In that case, that would still qualify for reduced exclusion, even though the unforeseen circumstance didn't particularly happen to me. It still affects me, right? Because I'm the co-owner of the property. So the unforeseen circumstance can involve the taxpayer, so you, your spouse, or a co-owner or a member of the taxpayer's household. Reduced exclusion. Let me give you the formula for how to calculate the reduced exclusion. And this is basically right from the IRC code, which means it's written in legalese and it's really kind of dry and difficult to understand. But I'm going to give you examples in just 1 minute so that you can see how the math actually works. But this is the actual formula. So the partial exclusion is based on a fraction, which is multiplied by the maximum allowable exclusion. So you multiply basically the number of days that the taxpayer actually lived and owned the home by the maximum amount that they would be able to exclude if they had actually met the 2-year ownership and use test. Got it? So the numerator of the fraction is the shorter of the period of time the taxpayer owned the property during the 5-year period ending on the date of the sale, or the period of time the taxpayer used the property as the taxpayer's principal residence during the 5-year period ending on the date of the sale, or the period of time between the date of the prior sale or exchange of the property for which the taxpayer excluded gain under Section 121 and the date of the current sale or exchange. Okay, so that's what it says in the code. Now, the numerator of the fraction can be expressed in days or months, and the denominator of the fraction is 730 days or 24 months. That's the 2 years that we keep talking about, right? They have to have lived and owned the home at least 2 out of the last 5 years. So 2 years is 730 days. That's 365 times 2, right? I know that leap years are a thing, but we're not going to talk about it. We're not going to talk about it here. You don't like deal with leap years in this calculation. So it's just 730 days if you're counting the days, or if you're counting the months, then it's 24 months, right? 24 months is 2 years. How many months are in a year? 12, right? So 12 times 2 equals 24, depending on the measure of time used in the numerator. And like I said, I'm going to give you examples in a minute because I know that this is kind of difficult to understand if I'm just explaining what's in the code, because the code is written by lawyers, not normal humans. Okay. So last thing that I'm going to discuss before I give you examples is the sale of land. So just so you know, the sale of land doesn't qualify for the Section 121 exclusion. So if the taxpayer sells land where the main home is located but not the actual house itself, the taxpayer can't exclude the gain. And then the sale of a vacant plot of land with no house on it also doesn't qualify for the Section 121 exclusion. It doesn't matter what the taxpayer's intent was. If a taxpayer bought a plot of land, like an empty plot of land, with the intent of building their home on it, but they didn't actually build a home and live there, then it's not that plot of land doesn't qualify for the Section 121 exclusion. It has to have a house on it the taxpayer actually lived and owned, like lived in and owned, in order to qualify for the Section 121 exclusion. Now, there is an exception to this rule in the pubs if it's a situation where a taxpayer, for example, maybe they have a house and a huge plot of land next to it. You know, they have like horse property or farm property next to the house, and they sell the house and the farm separately, but the sale is kind of closely related. There's a time limit that the IRS gives where you can still qualify for the Section 121 exclusion if they're closely related sales. I don't talk about that because it's kind of a narrow exception, but it is in the pubs. You can't just sell land and qualify for the exclusion. But if you have a situation where the taxpayer sells house and land together, but it's not immediately one after the other, you know, maybe they sell the house and then they sell the land like 6 months later, then it's still possible for the taxpayer to qualify for the Section 121 exclusion if it's a closely related sale. That exception is in the pubs. I'm not going to cover it here. But just realize that there has to be a house somewhere in the mix. You can't just sell raw land or empty land with no house on it and qualify for an exclusion. The taxpayer can still get long-term capital gain treatment, which is good, right? They'll still get long-term capital gain treatment if they own the property for more than a year, but there's no way you can exclude the gain if there's not a house somewhere in the mix. All right, it won't qualify for the Section 121 exclusion in that case. All right, let's go over some examples so you can understand this stuff really well. Example number 1. This is the special rule that applies to married couples with regards to the ownership and use test. Carlos owns a home that he has lived in continuously for a decade. So he owns the home. He's already lived in it for 10 years, really long time. On June 1st, 2017, he marries Jasmine and she moves into the home, and they both live in the house together until December 1st, 2021, when the house is sold. Carlos meets the ownership test and the use test. Jasmine does not own the home because Carlos is listed as the sole owner of the property and the only one listed on the deed, right? So he owned the house already before he met her. So he's going to meet the ownership and use tests. But she doesn't meet the ownership tests because only Carlos owns the home. But since they're married, they're allowed to exclude up to $500,000 if they agree to file jointly. So that's a benefit, right? So he's the only owner, but Jasmine is his wife, and they both have lived in the home at least 2 years. He's owned it and lived in it for more than 10 years, as it says in the example, because he owned it and lived in the home when he met her. And then he married her and she moves in, but she's never added to the deed. But she doesn't have to be. As long as they agree to file jointly, they can still exclude up to $500,000 of the gain. So if they sell the house, then they can exclude up to $500,000 of gain, $500,000 of profit on the sale. Now, if Carlos and Jasmine had just been boyfriend and girlfriend, like for example, if she had moved in with him, but she hadn't married him, then he would only be able to exclude $250,000 of the gain, and she wouldn't be able to exclude any of it because she was not an owner and she's not his wife if they were just boyfriend and girlfriend. But that's not what happens in this scenario. In this scenario, they're married, and if they are married and they agree to file jointly, they have to file jointly in order for them to get the 500,000 exclusion. If they file separate returns, then only Carlos is going to get 250,000. They have to file jointly in order for this to work. But if they file jointly, then only one of them has to own the house, as long as they both meet the use test. So because she lived in the house, Jasmine lived in the house at least 2 years with him, then if they file a joint return, then they can exclude up to $500,000 of gain, $250,000 each, even though Carlos is the only one that owns the house. Okay, so special rule for married couples. Okay, second example. Irene owns her home and has lived in it continuously for the last 7 years. So Irene automatically is going to pass the ownership and use test. She's owned the home and lived in it for more than 2 years. She meets Julian and marries him in September 2021. They move in together, but Julian doesn't like Irene's house, and he convinces her to sell it a few months later. Irene sells the home on December 10th, 2021, and has a $350,000 gain. Irene meets the ownership and use test, but Julian does not meet the use test because he only lived in the house for a few months. Irene can exclude up to $250,000 of gain on her tax return, whether she files married filing jointly or married filing separately. The $500,000 exclusion for joint return filers does not apply. So do you understand how this scenario is different than the last one? In this case, Irene owned the home and lived in it for 7 years. So she's going to get the $250,000 exclusion no matter what, right? But she meets Julian in 2021 and marries him. So they're married and he moves in, but he doesn't meet the use test. He only lived in the house for a few months. So in order for that $500,000 exclusion for married couples to apply, only one of them has to own it, but they both have to meet the use test. In this case, Irene meets the use test, but Julian does not. So Irene can exclude $250,000 of gain, whether she files married filing joint or married filing separately. It doesn't matter in that case because Julian doesn't meet the use test, so they can't exclude 500,000. They can only exclude 250, whether they file jointly or separately. And she's going to have a partially taxable gain because she had $350,000 of gain and she can only exclude 250,000. So she's going to have $100,000 of long-term capital gain that she's going to have to pay tax on. Now, if they had kind of like buckled down, and if Julian had lived in the home for 2 years and then they had sold it, then they would have gotten a $500,000 exclusion at that point, even if Irene was still the only one listed on the deed. But in this scenario, they're only going to be able to exclude 250,000 because only Irene meets the tests. Sometimes you will have a property that's a partial use property, which means that only part of the property qualifies as a main home for the taxpayer to exclude a portion of the gain under Section 121. The most common scenario where this occurs is where a taxpayer owns like a duplex or a triplex, and they live in one unit and then either rent out the other units or let other family members or friends live in the other units. In that case, then only the portion that qualifies as the taxpayer's main residence is going to qualify for exclusion under Section 121. And that's regardless of whether or not the other units are rented to actual tenants or whether, someone else lives in the other unit like another family member. So let me give you an example. Mickey lives in one half of a duplex that she owns, and she lets her brother live in the other unit of the duplex rent free. Sometimes it'll be a situation where it's a rental property too, and in that case, you would still have to do the proration. Or sometimes it will be a situation where it's a duplex like this, and they won't let their family member live in it rent free, but it'll be a below market rental, so that the other half is considered like a below market rental. And in that case, it still wouldn't qualify for the Section 121 exclusion either. So you'd have to do a proration, you'd have to do the math in this case. She purchased the duplex 10 years ago for $200,000. This is her cost basis, right? This is what she paid for it. In 2021, Mickey sells the duplex for $340,000, which is a gain of $140,000. So this is her gain. Her gain is $140,000. The difference between what she sold it for and her cost basis, what she paid for it. But only half of the duplex counts as her main home. So she lived in one unit, but the other unit was her brother's, right? And he's not an owner. She just let him live in that unit rent free. We're trying to keep it easy in this case. But if it was a rental property and she was renting to even an unrelated party, she'd still have to do this calculation. So since only half of the duplex counts as her main home, Mickey may exclude only half of the gain. So half of 140,000 is 70,000. So she would not have to pay tax on $70,000 of the gain. Now she must report the other 70,000 as long-term capital gain on Schedule D, right? So she has a long-term capital gain on the other half. And this is assuming that the duplex, the two sides are of equal size. So then one half of the gain, exactly one half, would be eligible for Section 121. She'd be able to exclude that because that's the half of the duplex that she was living in as her main home. All right, let me give you an example of non-concurrent ownership and use. Now, in order to pass the ownership and use test, you have to have lived in the home and owned the home at least 2 years. But those time periods don't have to overlap necessarily, although usually they do, right? So if you have somebody who buys a house, then they're usually living in it at the same time that they own it. But they don't always, the time doesn't have to be concurrent because there's a 5-year look back period in order to satisfy these two tests. So a taxpayer can still qualify for the Section 121 exclusion if they own the home and use the home for 2 years, even if it's not all at the same time. And let me give you an example. Mabel bought her house on September 1st, 2017. After living there for 10 months, she moved in with her boyfriend and left her house vacant. So she owns the home, she lived in it for 10 months, and then she moves out of her house to move in with her boyfriend, and she leaves her house vacant. If she had rented the home during that time, put it on Airbnb as a short-term rental, or even if she had rented it to month-to-month tenants, that would be okay too. She can still qualify as long as she meets the test in the look-back period, because remember the look-back period is 5 years. So she buys the house September 2017. She only lives there for 10 months, and then she moves in with her boyfriend. They later break up, and Mabel moves back into her own house. She lived there for an additional 16 months until she sold it on September 1st, 2021. Mabel meets the ownership and use test because during the 5-year period ending on the date of the sale, so the date of the sale is September 1st, 2021, and you look back 5 years from that date. You look back 5 years from the date of the sale. She owned the house for more than 2 years. So all the time between 2017 and 2021, she owned the house. So she meets the ownership test, no problem. And then she also meets the use test because she lived in the house for a total of 26 months. She lived in it for 10 months right after she bought it. And then she moved out and moved in with her boyfriend for a little while. And then she moved back in for 16 months and then sold it. So 26 months is a little bit over 2 years. So she meets the ownership and use tests, even though she didn't live in it, the whole time. But altogether, she lived in the home for 26 months. So that's more than the required 24-month or 2-year period. So if she sells the home at a gain, she can exclude up to $250,000 of gain because she's the only owner. She's not married. She just moved in with a boyfriend and then moved back out. Okay, so she would get the full exclusion. Okay, periods of absence. So you have to know what qualifies as periods of use. Periods of use. Like I said in the earlier slides, short absences, like short vacations, qualify as periods of use. So you would treat those short periods of absence as time actually lived in the home, if it's a short vacation or something like that. But if it's a long period of absence, like a year, then the IRS has stated that that doesn't count as a period of use. Okay? These two examples are based on the examples in the IRS publications. Okay? So example number 1. Alana is a college professor who teaches medieval history. She purchases and moves into her home on April 1st, 2019. On August 1st, 2020, she moves abroad for a 1-year sabbatical to study ancient manuscripts in Germany. On August 1st, 2021, she returns to the US from her sabbatical, and on September 1st, 2021, she sells the house because she wants to move into a smaller apartment. Even though she owned the home for over 2 years, so she bought it in 2019 and then she sold it in 2021. So she actually owned it for more than 2 years, but she doesn't meet the use test because her sabbatical doesn't count as a short temporary absence. So she's not entitled to take the Section 121 exclusion because she didn't satisfy the use requirement. So she's not allowed to exclude any of the gain from the sale in this case. Example number 2. Juanita bought her home on February 1st, 2018. Each year she leaves her home for a 2-month vacation in Ecuador. Juanita sold the house on March 1st, 2021. She may exclude up to $250,000 of gain. Her vacations are treated as short temporary absences and are counted towards her periods of use. So she would count the time that she was on vacation as time living in the home because they're short. 1 month, 2 months, that sort of thing. But if you're gone from the house for a year or longer, then that doesn't count as a period of use. All right, let me give you an example for the military exception. And this is a situation where it's military personnel, and instead of a 5-year look-back period, they get a 10-year look-back period, which means they have a lot more leeway in order to satisfy the ownership and use test with regards to their personal residence. So example, Ensign Smith is a U.S. naval officer. He is single and owns his own home. Ensign Smith bought and moved into his home on January 2nd, 2013. So this is when he bought it, 2013. He lived in it as his main home for 2.5 years. So he met the ownership and use test already. But then in the following 6 years, he didn't live in the home because he was on qualified official extended duty with the U.S. Navy. So he bought the house, he lived in it and owned it for 2.5 years, and then he basically gets transferred. And for the next 6 years, he's on official extended duty with the U.S. Navy. Let's say he's living overseas, he might be on a military base somewhere, but he's not living in the house. Now, he could rent it during that time. He could have a family member live there. He could have it vacant. That's all fine. And if this was not military personnel, they wouldn't be able to qualify for the Section 121 exclusion because there's only a 5-year look-back period. And he was actually gone from the house for 6 full years. But since he's military personnel, he gets a 10-year look-back period. So he doesn't look back 5 years, he gets to look back 10. So in order to meet the use test, he may suspend the normal 5-year test period for the time he was on qualifying official extended duty. This means that Ensign Smith can disregard the 6 years that he lived abroad when he is calculating his period of ownership and use. He meets the ownership and use test because he owned and lived in the home at least 2 years in the last 10 years. Ensign Smith may exclude all the gain from the sale on his individual tax return. So if this had been any other person, then this sale would not have qualified for the Section 121 exclusion because he bought the house, he lived in it for 2.5 years, and then he moved out and he was gone from the home for 6 years. So everybody else gets a 5-year look back. But in his case, he gets a 10-year look back because he was on qualifying official extended duty and he's military personnel. So he can disregard the 6 years that he lived abroad and he still qualifies because he actually did at some point in there actually use the home for 2.5 years and he's owned it the whole time. So he's owned it since 2013. So the ownership test he meets just automatically. But the use test he also meets because even though the home was vacant for the last 6 years, he gets a 10-year look back rather than a 5-year. So he gets to exclude all the gain. He had $125,000 gain. He gets to exclude all of it. And he would be able to exclude up to $250,000 if he did have that much gain. And then if he was married, then he and his spouse would be able to exclude up to $500,000 on a jointly filed return. Okay, so that's how it works for the military exception. Okay, exclusion after the death of one spouse. So this is another type of exception or a loophole or whatever you want to call it. But this one only kicks in if one of the spouses passes away. So in this case, if one of the spouses dies, then the ownership and use period of the decedent, the dead spouse, tacks on to the survivor. Okay, and then the survivor is still allowed to exclude up to $500,000 of gain in that case. So let me give you an example of how this works. Harmony owned and lived in her home for 7 years. So Harmony is the owner and she lived in the home and owned it for 7 years. She marries Gerard on January 10th, 2021, and he moves into the home with her. So Gerard just moves into the home in 2021. He hasn't lived in the home or owned the home for 2 years. All right. Harmony dies suddenly 6 months later, and Gerard inherits the property as her spouse. He did not remarry. Gerard decides to sell the home on December 1st, 2021. So Gerard actually didn't even live in the home for a year, and Harmony was the owner, and then he inherited the property once his wife died. So he didn't own the home for 2 years either, because he just gained ownership of the home after his spouse passes away. So he hasn't technically met the ownership test or the use test. However, because his spouse passed away, he meets the requirements for Section 121 because his period of ownership and use includes the period that Harmony owned and used the property before her death. So these special rules apply because one of the spouses passed away. So Harmony died. So her ownership and use period tacks onto him. Harmony owned and used the property before her death for 7 years, as it says here. So Gerard may exclude up to $500,000 of the gain under the special rule that applies to deceased spouses. So he gets her $250,000 exclusion, and he also gets his $250,000 exclusion because she would have qualified if she was still alive. And then because she's dead, her ownership period and her use period tacks onto him. So then he automatically qualifies too. And he's actually allowed to exclude up to $500,000 of gain if he sells the property within 2 years of her death. All right, that's just a special rule for deceased spouses. And just remember that in order for this fantastic exception to apply, somebody's got to die. So it's, oh, that rhymes, right? In order for this to apply, somebody's got to die. So it's a loophole, right? Technically. But in order for the loophole to kick in, somebody's got to die. So in this case, only applies if there's a decedent in the mix. Okay? All right. Now, reduced exclusions. So every example that I've been giving you so far has been a situation where the taxpayer is allowed a full exclusion. So they are allowed to exclude a full $250,000 of gain, or in the case of a married couple, it's $500,000 of gain. Now, when we're talking about reduced exclusions, this is a scenario where a taxpayer will qualify for an exclusion, but they're not allowed to take the full 250,000 or the full 500,000 in case of a married couple. They're allowed to take it, but they're only allowed to take less. And the amount of the reduced exclusion that they are allowed to take is going to be based on how long they actually owned or used the home. Okay, so let me give you some examples and I'm going to show you how the math works. So example number 1. On January 5th, 2021, Jareth, who is single, purchases his home and uses it as his principal residence. On July 5th, 2021, which is exactly 6 months later, Jareth is forced to sell his home because his employer transfers his job to another state. So he has a job transfer, all right? And by another state, let's just assume that it's more than 50 miles away from his old workplace. So he does qualify for reduced exclusion based on his circumstances. And in order to find out how much he would be able to exclude on the sale, what you have to do is multiply the number of months or days, if you're going to do days, but the number of months that he actually did own the home and use the home. So he lived in it and owned it for 6 months. And he does qualify for reduced exclusion because of the job transfer, but the maximum exclusion applies if you live in the home for 2 years, own and live in the home for 2 years. So that would be 24 months, but he only lived in it for 6. So you multiply 250,000, which is the maximum that he would ever be able to take, right? So you multiply 250,000 by 6 over 24 months. That's the fraction. $62,500. That's the answer. That's what he would be allowed to exclude. That's the maximum based on the number of months that he actually did live in the home and own it. If his gain on the sale is less than $62,500, then he will not have a taxable gain. Okay? And in this case, whenever you have a reduced exclusion, you always want to report it. Because most of the time, when the taxpayer doesn't actually live in the home and own the home for 2 years, then the escrow company or the title company is always going to send a 1099-S. So the taxpayer will get an under-reported notice if this isn't reported correctly on the tax return. Even though I know the IRS says that if you can exclude the gain, you don't have to report it, just save yourself the headache and put it on the tax return. So you understand how the math works here, right? So 6 months is the amount of time that he actually owned and lived in the home. Okay? Example number 2. Pilar, who is unmarried, lived in her principal residence in San Francisco for 1 full year. So 365 days exactly. She only lived in the house for a year. And then she sells it. The sale generated a $260,000 gain. So I wanted to give you an example of a situation where a taxpayer might have a crazy amount of gain after only a year of living in the home. And just, places like San Francisco, Manhattan, sometimes San Diego, LA, you'll have situations like this where a person will have an enormous amount of gain, a ton of gain, after only a short amount of time. And this can happen, right, in certain areas. And just realize that if you get a question like this on the exam, don't immediately think, oh, $250,000 exclusion, because this is a trick question. She only lived in the house and owned the house for a year. So she's going to qualify for the reduced exclusion because she recently became unemployed. So unemployment is an unforeseen circumstance, and she'll qualify for reduced exclusion, but she's not going to be able to exclude all of that gain. And she's not even going to be able to exclude $250,000 of that gain because she only lived in the house and owned it for a year. Okay? So she could no longer afford the home and had to move back in with her parents. So she sold the house, but she only lived in it for 365 days. So Pilar can exclude $125,000 of the gain. So that's $250,000, which would be the maximum that she would be able to exclude if she actually had lived in the home and owned it for 2 years. But remember, she only lived in it for 1. 365 days exactly. So in this case, you would multiply the maximum exclusion, which is 250,000, by 365 days divided by 730 days. So this is a very easy example, right? Because 730 is just 365 multiplied by 2. Just realize that most of the time it's not going to be exactly a year. It's going to be like 75 days or 128 days or whatever. Sometimes you're going to have to count the days. And so this is how the fraction works, because 730 days is 2 years exactly. It's 365 multiplied by 2. And just realize on the exam, if they give you months, if they tell you, oh, they lived in the house for 8 months or 9 months, then you do the fraction like this. And if they tell you days, then you're going to do the fraction like this. Okay? And you always multiply, when it's a reduced exclusion, you always multiply it by the maximum exclusion amount. So for a single filer, an unmarried person, it's always going to be 250,000. And for a married couple, it's 500,000. Okay, assuming that they meet the tests. Now, the remainder of the gain would be taxable and cannot be excluded. So she's going to pay tax on the remainder of that gain. And here's another tricky thing. Notice that in this example, she only lived in the house for 365 days. She only owned it and lived in it for 365 days, which means she only owned the asset for exactly a year. So what happens when you only own an asset for a year or less? It's short term. So she's not going to get beneficial capital gains tax rates on this gain because it's not a long-term holding period. For long-term, it has to be a year and a day. So that's a little tricky thing too. I want you to remember that for the test. For an asset to be considered long-term and for the taxpayer to get beneficial long-term capital gains tax rates, the taxpayer has to own the asset for at least a year and a day, unless it's inherited, right? So we've already talked about that, right? So if it's inherited property, it's always long-term because somebody died. But if it's a situation where there's nobody dead in the mix, then in order for it to be a long-term holding period, it has to be at least a year and a day. So she only lived in it for a year. So the rest of the gain is going to be short-term capital gain, which means she's going to pay tax on it at ordinary income tax rates. Whatever her tax rate is on her ordinary income, that's the tax rate that she's going to pay on the remainder of the gain. She can exclude 125,000, right? Because she qualifies for reduced exclusion because she lost her job. So that's a qualified unforeseen circumstance. But she can only exclude 125,000 because she only lived in the house for a year. All right, land sale. So Bernarda purchased an empty lot 3 years ago for $90,000, planning to build her dream home. So she had high hopes. She had dreams and intentions. Construction was delayed and her house was never completed. In December 2021, Bernarda sells the land for $150,000. She owned the property for more than 1 year, so she has $60,000 of long-term capital gain. But none of the gain can be excluded from income because there is no residence on the property. Section 121 only applies to actual homes, not to an empty lot. They might give you a trick question like this on the test. So just remember, if it's a land sale, it doesn't qualify. And it also wouldn't qualify if, for example, she had finished part of the house, or she had finished even all of the house, but she'd never even set foot in it or lived in it, and then she sells it before she actually lives in the home. So you have to meet the ownership and use tests, which means you have to own the house, plus you have to use it for at least 2 years. And in this case, it was just land. So she's going to get long-term capital gains tax rates on this, but she doesn't get to exclude any of the gain. All right, next unit is Unit 9, which covers rental and royalty income.